Well, good afternoon, everybody, and welcome to the Berry and Oak Autumn Budget webinar. It's lovely to see so many of you joining us, and I know quite a few people have asked for a copy of the webinar afterwards so they can watch it at their own leisure. As always, our aim is to take what we feel can be a very technical and complex budget and translate it into clear, practical implications for your own financial planning. I'm going to be going through the key announcements and what they mean for you, and also where any opportunities or pitfalls may be. As a reminder, this session is for general guidance only, and it isn't personalized advice. And we recommend, because everybody's situation is unique, that you get personal advice rather than this general part. So how it's going to run today is I'm going to take you through the major changes, especially around income tax, pensions, ISAs, and inheritance tax. There's also a few surprises that didn't make it in the headlines. And if you have any questions, please send them to us afterwards because I want to keep the flow of the webinar going, and we'll make sure they get answered after today's webinar. But moving on, one thing I thought I would just do first of all is something that's gone under the radar recently is there has been a change to the financial services compensation scheme limits for bank accounts especially. And that means it's going up from £85,000 per person per authorised firm to £120,000. And the temporary high balance when you've done things such as selling your home, received inheritance or cashed in an insurance payout has gone up from 1 million to 1.4 million. So this affects changes at all UK authorised banks and building societies, but do remember some banks share a banking license. So if you've got money with Halifax and Bank of Scotland, for example, or HSBC and First Direct, they come under those two come under the same allowance. You can't have 85,000, sorry, in the new limit, 120,000 with Halifax and 120,000 with the Bank of Scotland. It is only one limit. And that actually came into effect today. So that's just a little bit extra I want to make sure people were aware of. But moving on to the budget, then what's the overview from the budget? What's changed and why it matters? Now, there's been quite a few tax rises, throws and thresholds in there, as well as some ISA restructuring. The government's got an extra 26 billion in revenue rising from there. And having read the 188 pages of the government's document about the budget, which goes into much more detail below the headlines, it's fair to say that tax is now getting very complex. Personally, I wouldn't want to do my own tax return anymore. There's too many different boxes, tax treatments, ways to slip up that if you're not doing it already, I really recommend getting an accountant to help you with your tax return, especially if you've got different forms of income, property income, dividend income, because it's just getting crazy. It's not a book of our tax anymore. It must be a whole range of encyclopedia. That's how detailed there are now. Also, I think this budget could call it the hokey cokey budget. And we were thinking here that we could almost have a soundtrack to the budget. You put a tax rise in, you take a tax rise out. I've never seen a budget before with so much what we call kite flying, where ideas are raised of what we might do, and everyone goes panicking that this might happen or something else might happen. Then it gets pulled, then something else gets raised. And we don't even want to talk about the fact the budget was even leaked before the budget was done. What an absolute mess. But also, this budget is really going to become down as a very much a stealth budget as well. A lot of headlines people see, but more of it has actually flown under the radar. In total, there were 43 different tax measures and 45 new spending measures. That's a very, very busy budget. Also, what's important to be aware of is a lot of these changes aren't happening at the same time. Some are from April 26, some are 27, some 28, even going on to 29 and beyond. So it's having to plan and understand when different changes are going to happen. And these tax changes are going to be felt by many people, and initially you might not realize the impact of them, but you will find very soon you are paying more tax. So I also think it's probably very important to talk about what didn't happen in the budget, because as I said, there was lots of speculation and kite flying and lots of panicking about what could happen. But more importantly, tax-free cash on pensions, despite all the worry that it was going to get capped, withdrawn, and everything else, I'm pleased to say that my prediction that it would be unchanged has come true, and that no changes there. Tax relief on contributions to pensions. There was a concern that money being paid into pensions might get a lower rate of tax relief going forward. But apart from the changes to salary sacrifice, which I'll talk about shortly, there's been no change there. Also, there was a worry about caps on gifting for inheritance tax or extending the 7 year gifting period to maybe a 10-year period. And again, fortunately, so far, there's been no changes there. And also, it was muted that capital gains tax rates might change and align with income tax rates, but there's been no changes to those either. And that's why it's more important than ever to plan by the rules and legislation that's in place at the time, not by media speculation or what the friend in the pub says. It's important to plan by what's actually in place and not trying to second guess, because there are people out there that probably made bad decisions, not clients of Berry Note because we helped you do the right thing, because they acted on media impulses and scare stories. But moving on to some of the changes that happened, property income, dividend, and savings was probably a fairly big change. For savings interest, for money that's not sheltered inside cash ISAs, for example, from April 27, there's going to be a 2% increase for all tax bands. So on your savings interest, you'll be paying either 22%, 42%, or 47%, which is, crazy that we're supposed to be encouraging people to be saving, and now we're penalising them for doing so. If you're in investment bonds, the taxation in turn will align for those as well. Those receiving dividends, whether that's from your business or from investments, from April 26, so that's coming up very shortly, there will be a 2% increase for basic and higher rate taxpayers on the amount of dividend tax. But the additional rate taxpayers, there's been no change to that level of dividend tax. Initial assessments might mean that people in small, medium enterprises may not shift their remuneration strategy yet, but it's getting close whether they'll be switching away from dividends to more of a higher salary. And then the other change, which will again be in April 2027, so we've got a bit longer for this one, is income earned from property, whether that's land or buildings, is going to have an extra 2% added to the rental income from there. So now it'll be again at 22, 42, or 47%. So a little bit unexpected on that part, tilts the income planning quite significantly. It makes pensions more attractive in some bits because they're going to pay a slightly lower level of tax than property income, savings, or dividends. But also, it's important as ever to make sure you're going to be using all of the family's allowances when there's gifts, or be able to use them to keep the tax bit down, and restructuring between ownership to make sure the lower paying tax person is receiving the income. Next, we come on to the big freeze, income tax thresholds, which despite a year before the Chancellor saying she would not be doing because it would be unfair on the working man, stroke woman, although I'm not sure they've actually still don't understand who that definition applies to. But now this is going to be a freeze until the 2030-31 tax year. So it's what's called fiscal drag that this is going to be. And fiscal drag is a way that it's just really is just a stealth tax. And here, that's where the tax bands will stay exactly the same as they are now, but hopefully your income will increase each year. And because those tax thresholds have not changed, more of what you earn will end up being taxed. And some people, and you can see on here, 5.2 million more people will start paying tax than do today, and 4.8 million will become higher rate or additional taxpayers. That's 4.8 more people will it end up in that tax band. So without the chancellor ever announcing a tax rise and nothing's changed on paper, but somehow the tax band's going to walk away with more of your money. There's also another important bit that income tax ordering rules are to change because it always used to be that they were taxed in a certain way of the income that you were earned, and you could offset allowances to reduce your tax bill. It's coming out that that's going to change now, and there's going to be a slightly different order to how your income is taxed, which means that those paying the most tax, such as property income or dividends, will be further down the line, so that you will definitely pay the higher amount and not be able to offset things like your personal allowance against it. So, from a planning implication, it's important to review your income drawdown strategies, use everybody in the family's allowances every year. Make sure you've considered different tax wrappers, whether that's ISAs, pensions, investment bonds, even more specialist investments as well. And you may want to, if you're paying yourself a low salary and high dividend to your business, considering whether salary is more appropriate for you. Moving on to pension salary sacrifice reform, which again was mooted a lot before the budget. And with this, from April 2029, which is a few years off, if you're sacrificing more than £2,000 a year, and this is when people decide to take a lower salary, and in return, their employer puts the same amount into their pension for them. And the advantage of that is they pay less national insurance, both the employee and the employer. And often the employer will add that national insurance savings that they've made into your pension for you, which gives your pension a nice big boost. But from April 2029, more than £2,000 per annum paid in will not get this national insurance exemption. And that will apply to both the employee and the employer. So, what does that mean? Who's affected? Well, if you're paying 5% into a pension, an employee only earning £40,000 or more will be affected. The biggest impact will be those people between 40,000 and £50,270 as earnings, because in that bracket they're paying 8% national insurance, which is what they'll lose on those excess contributions before national insurance drops to 2% above the 50,000 limit. As I've just mentioned, if your employer's adding the national insurance saving, which is 15% that they pay into your pension, and then stop that on the excess, that means your pension contributions are going to be less, and therefore your pension pot is going to be smaller. So planning ideas from here is look at maximize contributions that you can do under salary sacrifice before 2029. Even after 2029, when the national insurance benefits are removed, it could still be very worthwhile if it keeps you under tax thresholds, such as the £100,000 threshold where you start to lose your personal allowance, or threshold where you retain child benefit. State pension. Well, what's changing here? This was more about confirmations that the new full state pension will rise to £241.30 a week from April 2026. That's a 4.8% rise. It's been confirmed that the triple lock will be retained for the rest of Parliament. What happens after that, who knows? And they're also, from an administrative point of view, looking at solutions to avoid pensioners paying small amounts of tax when the state pension exceeds the personal allowance. This is because, as it is now, the annual state pension is just under the personal allowance. And for some people, if that's their only level of income, when the state pension goes up in the next 2 or 3 years under the triple lock, we know the personal allowance isn't going to change. They're going to have a small amount of their state pension, which effectively will be taxed. So they're looking at ways of actually excluding people on just state pension from paying tax at all. Another announcement was around the national living and minimum wage changes, especially affecting younger people more. Those over 21, they've had a 4.1% increase. 18 to 20-year-old brackets have had an 8.5% increase, the biggest increase of all. And 16 to 17-year-olds, they're going to get a 6% increase in their minimum wages. The worry from a lot of people is whilst it's nice to give people a pay rise, this has got a very significant chance of impacting youth unemployment, which is already at significantly high levels, because there's going to be a disincentive for employers to take on people in this bracket because they get too expensive. And I think especially people that are younger that get like summer jobs or part-time work after school, especially in hospitality, whether that's work in the bar or waiter, waitress, etc. I can just see some of these pubs and restaurants saying they just can't afford the increase and they're going to have to cut back on their staff. Hopefully, we don't see that, but I think that's what will actually happen. Um, ISAs now, ISAs were very much in the news before the budget. That the cash ISA limit could be slashed, etc., and that has happened partially. There is going to be a new annual allowance structure. £20,000 is still going to be the allowance that can go into ISAs each year, but there's going to be a £12,000 cap on the cash ISA unless you're aged over 65. Above the 12,000 cap, the rest has to go to stocks and shares if you want to maximize your allowance in ISAs each year. And the rationale behind this is it will encourage long-term investing. In fact, it was quite interesting that the Chancellor quoted a comparison that if you'd invested £1,000 a year into equities rather than cash since 1999, you would have been £50,000 better off, which is quite a startling sum from just £1,000 a year. So, in a way, I do believe this is a good thing because there was a lot of money languishing in cash ISAs that aren't earning good returns. And if people can get a better pot in later life, that will be better for them. There's also a consultation to replace the lifetime ISA with something new dedicated to first time buyers. The lifetime ISAs had a bit of a bad rap, mainly because people used it inappropriately and in the wrong way. For those that have used it to save for their first house, I think it's been a great scheme. But we're going to tinker with it yet again, and we will waste thousands and thousands of pounds on consultations continuously. ISAs used to be a very straightforward product when they were first launched. Now there are so many different versions of ISAs, it's hard to keep up. So, from a planning bit, review your large cash ISAs. They might be changed in the future, such as a cap on total values. It's time to consider maybe stocks and shares ISAs if you've got a lot in cash ISAs. And if the lifetime ISA is available to you, you might want to consider using it now if it's suitable before it gets removed. Then moving on to VCT and EIS investments. These are quite specialist investments in startup and medium sort of term in their sort of investment journey plan investments. So for VCTs, which stands for Venture Capital Trusts, the upfront tax relief on those will fall from 30% to 20%. This might make them a bit less attractive, which is a shame. But the government, I believe, wants people to focus more on the SEED and EIS, which stands for Enterprise Investment Scheme investments that have retained the same income tax relief rates because they want to incentivize funds to support the high growth potential companies. So on these, for seed investments, you get 50% income tax relief still, and for EIS, it's 30%. There's also the availability of CGT reinvestment relief, which means you can write off up to half of your capital gain using CDIS, or you can defer capital gains with EIS. There's a function called loss relief. So if any of the underlying investments was to fail, you can get further tax relief. And after 2 years, they get inheritance tax relief. So can effectively, pay no inheritance tax on the money in these investments. There's also been some technical changes behind the scenes relating to the amount of money companies can receive from EIS and VCTs, because before there was a cap on they could how much they could have over their lifetime. They've practically doubled that now, which means, especially on VCT companies, the investments that are doing well, that need further investment for their next stage of growth, can be helped and supported as they get bigger, which will hopefully make them more successful. There also is a consultation to look to re-engineer the EIS and venture capital schemes so they don't just back the early stage ideas right at the outset, but can stay with companies all the way through as they grow and again make them bigger and stronger and more beneficial for everybody. Planning for landlords. Well, we couldn't resist putting this picture in, and unfortunately, it isn't this sort of landlord that we're talking about, although they're probably going to need some help with some of the costs and changes on business rates and staffing costs. But this is for rental landlords. There's now going to be a higher rate of income tax on rental income. It's going to be an extra 2p for basic, higher, and additional rates. They're the tax rates that you will end up paying. There's also finance relief is going to be available up to 22%. So from a planning idea, for some people, if you've got a number of buy-to-let properties, considering whether incorporation to a limited company is right. For others, is it time to sell or gift, or are you going to carry on holding on to these? Also, pension contributions can help with some of the additional tax that you're paying on your rental properties. And then another thing that was floated up there before the budget was the mansion tax. So on here, they're now introducing a high value property surcharge from 2028. I can see there being lots of disputes over valuations, and could end up bringing a bit of a hard ceiling on prices, that people don't want the price to go above 2 million before it takes a big jump on there. And it's going to happen at other price points as well, like the 2.5 million. You can see a lot of prices staying there for some time. But these amounts are going to be the extra annual amount due if that's the value of your property from 2028. My worry is this is the thin end of the wedge, and those rates could very easily change in future years, or even drop that bottom threshold to be lower valued houses being caught out. So it's time to be thinking about tax efficient income strategies going forward. For some, pensions might be used first because it's going to be a lower rate of tax than either savings income or property income. Investment bonds may be useful to come back as a good tax wrapper to use, as you've got a 5% withdrawal allowance. Tax is only paid at chargeable events. So in a rising tax environment, that might become something that's interesting for some people to be considering. The other big one that always gets people worried and panicking about when it comes to budgets is inheritance tax. So after last year's, though, was quite, a devastating raid on pensions, especially for inheritance tax, and a lot of changes around business relief for farmers, for AIM shares. It's sort of relatively nice to say there haven't been that many changes this year. Certainly nothing that's really substantial to make people wake up in the middle of the night. It has been confirmed that for some changes that were already legislated are definitely going to go ahead. So any unused defined contribution, so that's like basically invested pensions, will form part of the estate for inheritance tax purposes if death occurs from April 2027. But this won't apply for death benefits that have already been crystallised and paid out, or pensions under dependent pensions. It was also announced at last year's budget that for AIM ISAs, they would be getting a restricted to 50% inheritance tax relief, and for business relief, a cap of £1 million for business relief and agricultural relief to get the 100% inheritance tax relief, and it will drop to 50% IHT relief above that cap. They are going to go ahead from April 26. But one bit of good news that came out of this budget is they are going to introduce a spousal transfer of the unused portion of the £1 million allowance for business relief and agricultural relief. So the spouse who inherits can use the unused relief, because otherwise there was a bit of a quirk really where you wouldn't want to leave your business relief and agricultural relief assets to your spouse because your 1 million allowance would have been used up by doing so, and instead you would have probably wanted to left it to other members of the family, which didn't leave your spouse in a very good position. So that's a very good bit that the consultations have been able to push back on and get introduced. So for planning ideas for inheritance tax, prioritise drawing your taxable savings and investments before touching your pensions. Consider using withdrawals made from your pensions and savings investments to fund lifetime gifting. And also review any AIM, ISA, or business relief, agricultural relief holdings before the rules change to see if there's a different way they should be structured. Gifting and family tax optimization. Probably the most important bit here is it's important to have a plan. Number one, you need to make sure yourselves are financially secure and can do all the things that you want to do. But thereafter, if you've got an excess, it's what's the plan to limit any potential future inheritance tax, but also doing things where you're making gifts to your family at a time where you can see the benefit of them. You can see where it's going to get used from there, which a lot of our clients tell us is hugely valuable. But as I've mentioned earlier, it's important to maybe use all available allowances and wrappers for everybody. Interspousal transfers to make sure money's in the right hands for the lowest paying taxpayer. Considering joint ownership of assets if appropriate. And for your children or grandchildren, are you maximising their junior ISAs or pensions? So another tax wrappers that are available that often get missed. And for some, considering trusts for long-term planning. Finishing off with a few different bits that came out from the budget. First, there was the electric vehicle road levy. It's a bit of a worry between are we incentivizing people or not to go electric? We were pushing everybody to go electric, but to be honest, we all really knew that one day this would happen. And now there's going to be an introduction from April 2028 of a per mile levy for electric vehicles. I wonder whether this could lead to a modernisation of motoring taxation full stop. And rather than taxing it through the likes of petrol, etc., we all end up paying a per mile usage in the future. Bit like toll roads. Few spending and household cost key facts. Household energy bills, we've all seen them soar over the last few years. Well, from 2026, there's going to be £150 annual reduction. The government's decided they're going to cover 75% of the legacy renewables obligation, which is why they could be able to remove this from your electricity bill. But that does mean that you and me are paying it via our tax bills. The government's not paying it. Rail fares have been frozen for 1 year, and prescription charges have also been frozen. So trying to help some of the rises not happening on our expenditure. So that really concludes the budget webinar that we've done today. There's a lot of detail behind the scenes of this budget. For a lot of people, it's going to be the taxation, the various incomes that they've got. It's fortunate that there's not been many changes to pensions or inheritance tax that need wide-scale changes, but it's more important than ever to make sure you're getting help and support, looking at all the options available for you and your family, and making sure that you're taking the best steps. And as you know, that's what ourselves at Berry Note will do with you at your annual planning meeting. If you've got any particular concerns beforehand, just drop me a line and me and the team will be very happy to help. And if you've got any particular questions on the budget or from my webinar today, please send in an email and we'll get back to you as soon as we can. Thank you for joining us today and look forward to catching up with you all soon.